Someone gets paid. That is where it starts. Not with a press release or a prospectus, with a single person who got their money back, plus a little more and told someone about it at a barbecue. Her name, for the purposes of understanding this, is Linda. Linda is 58 years old. She is a retired dental hygienist. She has $22,000 in a savings account earning 2.1% APY and a vague sense that the financial system was designed by people who did not have her in mind. A man she knows through her church, someone she has known for 11 years, someone whose daughter was in the same dance recital circuit as her niece, told her about an investment opportunity. He used the word opportunity exactly once. After that, he just talked about what it had done for him. She puts in $4,000, not her life savings, not even close. A number she described later as, quote, what I would lose sleep over losing, but not what would ruin me. 8 weeks later, she receives $4,520 in her checking account. The memo line says investment return. She stares at it. $520 in 8 weeks on $4,000. That is 13% annualized if you hold the math steady, which you should not because the math does not hold. But she does not know that yet. She knows that her savings account paid her $38 last quarter, and this account paid her $520 in 2 months. She knows how those two numbers feel next to each other. Here's what actually happened with that $520. It did not come from a trade. It did not come from a business operation generating revenue. It came from the deposits of 3 other people who put money in after Linda did. The operator collected those deposits, held the principal, and distributed a portion as Linda's return. The ledger shows a gain. The ledger is a fiction. The cash flow is real. The source of that cash flow is the problem, and the problem is invisible from where Linda is standing. This is the architecture of the illusion at its smallest scale. One investor in, one payout out, funded by later money, experience as proof. The gap between what it appears to be and what it is measures exactly $520 and contains the entire logic of every scheme that has ever grown to $1 billion. Linda calls her friend, the one who told her. She does not call him to report a fraud. She calls him to say thank you, and while she is saying thank you, she mentions that her sister has some money sitting in a CD that is about to mature. This is not a referral in any formal sense. There is no commission structure yet. There is no script. There is only a woman who had a good experience and a sister she loves and a phone in her hand. The operator did not need to recruit Linda's sister. Linda recruited her sister. The scheme scaled one conversation at a time, and the people doing the scaling were not criminals. They were people who believed they had found something real. This is what Trust by Story does. A quarterly earnings report is abstract. A prospectus is 30 pages of language that requires a different language to understand. But Linda getting $520 in her checking account and telling you about it over dinner is neither of those things. It is personal. It is verified by your relationship with Linda. It carries the weight of 11 years of knowing her. The credibility is borrowed from the friendship, and the friendship did not consent to that use. The operator understands this without having to plan it consciously. He uses the language of exclusivity. He mentions that he is not taking new investors right now, that he made an exception for Linda because of who she was, that the people in this are not the kind of people who talk about it publicly. This language does several things at once. It filters out people who ask too many questions. It creates a social cause for skepticism, because to doubt the opportunity is implicitly to doubt Linda, and to doubt Linda is to introduce friction into an 11-year relationship. It makes each new investor feel selected rather than recruited. By the time Linda's sister puts in $9,000, there are 14 investors in the structure. Total deposits are approximately $87,000. Total payouts distributed are $11,400, funded entirely from incoming principal. The operator has touched none of the money yet, or almost none. The scheme at this stage is almost self-sustaining on new inflows alone. Almost. The pressure to find new investors is already compounding faster than most people in the structure understand. Linda does not fully understand what she consented to. This is not because she is unsophisticated. It is because the information she was given was not sufficient for any person to make a fully informed decision. There were no audited financials. There was no registered investment vehicle. There was no documentation of the underlying strategy beyond a description that sounded plausible and was never tested. She signed nothing that disclosed risk in plain language. She experienced a return and reasonably interpreted the return as evidence of legitimacy. This is how consent gets quietly hollowed out, not through deception in a dramatic sense, through the strategic absence of information that would have changed the decision. There is already something else present at this level that does not get discussed enough. Shame. The early investors are simultaneously the most vulnerable and the most socially committed. If this falls apart, Linda is not just a victim. She is the person who told her sister. She's the person who told two friends from church. She is the one who said it was real. The operator did not need to threaten her into silence. The structure of the social graph did that on its own. She will not ask hard questions because asking hard questions now, after the referrals, means something different than it would have before. That is the first payout, $500 and $20 in a checking account. An 11-year friendship weaponized by trust. 14 people inside a structure none of them can see clearly from where they are standing. And a number, $87,000 in deposits, that is about to get 1,000 in deposits, that is about to get much larger. By month 14, the structure has 61 investors. Total deposits are $743,000. The operator has distributed $94,000 in returns, funded entirely from principal. The gap between what is owed and what exists is not a crisis yet. It is a calendar. The calendar has no date printed on it, but it is running. This is the middle stage. It looks nothing like the beginning and nothing like the end. It looks, from the inside, like success. Here's what the investors see. They see account statements. The statements arrive quarterly, sometimes monthly. They show a balance, an opening figure, a return percentage, a closing figure. The numbers go up, not aggressively, not so fast that a careful person would flinch. 7%, 9%, 11 in a good quarter. The statements are formatted the way statements from legitimate institutions are formatted. There is a logo. There is a column labeled unrealized gains. There is a total portfolio value in the bottom right corner, and that number is larger than the one from last quarter, and that is the only number most people look at. What those statements do not show is a transaction. There is no underlying trade confirmation, no custody report from an independent clearinghouse, no third-party verification of any kind. The number in the bottom right corner was generated by a spreadsheet, not by a market. The gain is not unrealized. It is unreal. It is a figure someone typed, but it does not feel unreal. It feels like wealth. That is a specific and important distinction. A man named Robert is 67. He put in $140,000 18 months ago, money he rolled out of a 401k after taking early retirement. His current statement shows $161,800. He has not withdrawn a dollar. He is reinvesting the returns automatically because the operator told him that compounding was the whole point, that the investors who reinvested were the ones who would see the real gains, that taking distributions early was, quote, leaving the best part on the table. Robert believes this. He has no reason not to. His statement says $161,800. He feels for the first time in years like someone who made the right decision. What Robert cannot see is that he is now a net contributor to the distributions of every investor who joined before him. His $140,000 principal has been funding returns for others since the day it arrived. The $161,800 is a promise written in a font that looks like a fact. The liquidity question has not been asked yet. Not out loud, because no one has needed to ask it. Redemptions happen. Small ones. A woman named Patricia pulls out $8,000 for a kitchen remodel. The check arrives in 11 days. The 11 days felt slightly long to her, but the check arrived. And arriving is what matters. What she does not know is that her $8,000 came from the deposits of 2 investors who joined the week before, and that if 6 people like Patricia had asked for their money at the same time, the math would have required a delay that no explanation would have made comfortable. This is the liquidity mismatch. Every dollar in the structure is promised to someone. There is no liquid reserve proportional to total obligations. The operator cannot return everyone's money simultaneously. He never could. The structure only functions when most investors are not asking for their money at the same time, which is only sustainable for as long as most investors believe the money will be there whenever they do ask. The belief is load-bearing. The belief is the only thing holding the weight. The social dynamics at this stage are intense in ways that are difficult to overstate. There are group dinners now, a quarterly gathering at a restaurant with a private room. People know each other. They have met each other's spouses. There is a group chat with 43 members. Someone posts a return screenshot almost every week. The emotional texture is warm, specific, real. When a new investor joins, existing members feel validated. When someone expresses hesitation, the room does not attack them. The room gets quieter in a particular way, and the silence communicates something that no one has to say directly. Doubt here is not just a financial question, it is a social position. The cost of skepticism is paid in the currency of belonging. The warning signs are present, they are just dressed differently. A delay framed as a regulatory clearing window. A new minimum holding period explained as a structure optimization. A change payout schedule described as a move toward quarterly distributions that, quote, better reflect how the underlying strategy actually operates. Each explanation is plausible in isolation. Each one asks for a small additional extension of trust. And because each individual ask is small, and because the community around the investment is warm and real and human, the asks are granted one by one, in the same way they were always granted. The way you extend trust to people you know. Robert's sister-in-law puts in $55,000 in month 16. She is 71. She tells her daughter it is the most confident she has felt about a financial decision in 20 years. Her daughter has never heard of the operator. She does not ask. The statement shows $55,000. It will show more next quarter. The number will keep growing for a while longer yet. Paper does not know what it is promising. Only the calendar knows, and the calendar is still running. At some point, the structure crosses a threshold that changes what it looks like from the outside. Not what it is, what it looks like. The number of investors reaches a certain density. A few of them are notable. A retired federal judge, a former university president, a physician who chairs a hospital foundation. These are not people who were recruited carelessly. They were recruited specifically because their presence performs a function that no brochure can perform on its own. When a person of that standing has their name associated with something, the due diligence question shifts. It moves from, is this legitimate, to why would someone like that be involved if it weren't? The answer to the second question is assumed. The assumption does the work. Charitable sponsorships appear. A scholarship fund. A grant to a community arts organization. The operator's name on a plaque at a fundraising gala. None of these gestures prove financial soundness. A person can endow a scholarship and run a fraud simultaneously, but the brain does not process them that way. The brain files them under the same category. He gives back. He is established. He is the kind of person institutions trust. Authority bias is not a character flaw. It is a cognitive shortcut that works correctly most of the time, because most of the time, people with those affiliations and that social positioning did not get there through fraud. The shortcut fails specifically when someone has engineered the conditions that trigger it. Smart people get caught not because they stopped being smart, but because intelligence and expertise are domain specific. A cardiologist can read an electrocardiogram with precision and read a custody statement with none at all. A securities attorney can identify a defective indenture clause and completely miss that the fund has no independent administrator. Complexity is the mechanism. The offering documents are thick. The strategy is described in language that gestures at sophistication without permitting verification. Tranched allocations, dynamic rebalancing protocols, proprietary signal aggregation. The terms sound like something that would require significant expertise to question, and so most people do not question them. Questioning feels like an admission of inadequacy in a room where everyone else appears comfortable. Reputational herd behavior means that once enough credible people have accepted something, the social cost of dissent exceeds the perceived risk of participation. That calculation happens quietly in the back of the mind before the conscious one ever starts. But the math does not care about the room. The math is running its own calculation, and at scale, the calculation becomes brutal. When the structure holds $40 million in obligations and promises 9% annually, it needs $3.6 million per year in new money just to cover the returns it has already committed to before a single redemption, before operational costs, before any money the operator has extracted. At $200 million in obligations, that number is $18 million. The new money required to sustain the illusion does not grow linearly. It accelerates because each successful payout creates a new balance that also needs to be serviced next quarter. The structure is a treadmill that gets faster every time someone decides to reinvest. The investors who reinvest are not the ones who will see the real gains. They are the ones whose reinvestment buys the operator one more quarter of functioning. Regulatory attention arrives through different doors at different times. Sometimes a disgruntled former employee files a complaint. Sometimes a competing advisor notices that the reported returns are inconsistent with any known market condition during the same period. Sometimes the inquiry comes from a pattern, a concentration of complaints from a single geographic area, or a referral network that appears in multiple unrelated filings. What the regulator sees first is paperwork, and paperwork at this stage can still look clean. Audited financial statements exist, sometimes from a small firm no one has heard of, sometimes from a firm that is itself compromised, occasionally from a legitimate firm that audited only what it was shown. An audit of a Ponzi scheme does not always reveal a Ponzi scheme. It reveals the documents it was given access to. The gap between what the auditors examined and what actually exists is the same gap that exists between the statement Robert holds and the transaction that was never made. Then something shifts. It is usually not dramatic in the moment it happens. A market drops 11% over 6 weeks. It is a normal correction by historical standards. But the investors in this structure have been told they are not exposed to normal market conditions. They have been told the strategy is uncorrelated. So when the market drops, they expect their statements to hold steady. Some of them decide this is an appropriate moment to take some money off the table. Not all of them. Enough. A redemption wave does not require unanimity. It requires a threshold. When withdrawal requests exceed the available liquid capital, the operator must choose. He can pay some investors and not others. He can manufacture delays with explanations that grow increasingly strained. He can use new deposits to cover the redemptions of exiting investors, which compresses the remaining pool further and accelerates the very crisis he is trying to survive. There is no good option at this point. There is only the sequence in which things fall. The human fallout before any of this is public, is specific, and largely invisible. A couple in their early 60s begins arguing about whether to redeem. The husband wants out. The wife is afraid that asking for the money will feel like an accusation and will damage a friendship that matters to her. A man who recruited his brother-in-law cannot allow himself to believe the thing he is beginning to suspect, because believing it means he is the reason someone he loves is in this position. So he does not believe it yet. He calls the operator. The operator is reassuring. The call lasts 19 minutes. He hangs up feeling better. He does not withdraw. He will think about that call for years. Some people put more money in. This is not irrationality. It is the mathematics of sunk cost dressed in the language of loyalty. If you double down and you are wrong about the scheme, you lose twice. If you double down and you are right that it is legitimate, you recover the loss and prove your judgment sound. The mind finds this second scenario more bearable to hold, so it holds it. The calendar that was always running is now audible. The withdrawals stop, not all at once. First, there are delays. Processing times have extended. A system migration is underway. The funds are allocated in a position that requires a brief settlement window. The explanations are specific enough to sound administrative and vague enough to be unverifiable. Then the delays become non-responses. Then the phone number routes to a voicemail that is full. The moment an investor realizes that the money is not coming is not a dramatic moment. It is a quiet one. It usually happens alone, in front of a screen, reading a sentence that does not make sense. The sentence made sense last month. It does not make sense now. That is the whole collapse compressed into a few seconds of reading. The disclosure comes in one of several forms. A receiver is appointed by a federal court. A press release from the SEC or the DOJ names the operator, describes the structure, and uses the word fraud without qualification. Or a local news story runs, and someone forwards it to someone, and by the time the second person reads it, the first person has already gone silent. The silence that follows is not the absence of communication. It is a kind of grief that does not have a clean category. The money is gone. The relationship that brought you to the money may also be gone. The version of your future that was built around those returns is gone. You are not grieving one thing. You are grieving several things at once, and they do not all have the same shape. The harm is not abstract. A couple who planned to retire in 8 months does not retire. A woman who pulled equity from her home to invest does not recover it. A man who moved his mother's savings based on his own recommendation spends the next decade navigating something that is not quite guilt and is not quite grief, but borrows from both. Medical decisions get delayed. Mortgages go underwater. Marriages that were already strained do not survive the weight of a shared loss that one person blames on the other's enthusiasm and the other person blames on the first person's skepticism coming too late. The money was one number. The consequences are not one number. They are distributed across health, housing, trust, and time in ways that no restitution calculation has ever fully captured. Then comes the clawback, which is its own kind of wound. A clawback is a legal mechanism that allows a bankruptcy trustee to recover funds paid to investors who withdrew more than they originally deposited. The logic is equitable. If the structure was fraudulent from the beginning, then every dollar paid out to early investors was paid with money that belonged to later investors. The early withdrawal was not a return. It was, in legal terms, a fraudulent transfer. A person who invested $20,000 received $34,000 back over several years and believed they were earning legitimate returns may now be required to return $14,000 to the recovery pool. They were not a perpetrator. They were a victim who exited at the right time without knowing they were exiting anything. The clawback does not distinguish between luck and complicity. It distinguishes between net winners and net losers. That distinction is legally coherent and humanly brutal. It also reshapes the grief inside communities. People who referred friends begin to understand that their referrals cost those friends real money. People who referred friends and then withdrew their own principal before the collapse may find themselves clawed back, while the people they referred remain in the net loser category. The social geometry of blame becomes impossible to navigate cleanly. There is no gathering where everyone's experience of the same fraud is the same. The operator is charged. The investigation takes longer than anyone wants. The sentencing takes longer still. When the number arrives, 20 years or 12 years or 30 years, it does not return a single dollar to a single account. Prison is accountability. It is not recovery. The restitution order in the judgment is usually a number the court knows will never be paid in full. It is entered into the record because the record requires it. The victims know this. Knowing it does not make it easier to read. Recovery, where it happens, begins with documentation. Account statements, any written communications, transfer records, filing a complaint with the SEC, the FBI's Internet Crime Complaint Center, or the receiver's office if one has been appointed. Connecting with fraud counseling services, which exist specifically because financial trauma does not resolve through budgeting alone. Rebuilding slowly, with instruments that are simple enough to verify, boring enough to require no trust in a single person's word, liquid enough that you are never again in a position where asking for your money back feels like an act of courage. Verify before you invest. Slow down when urgency is applied. Ask who holds the money, who audits the money, and whether those answers can be confirmed by someone with no stake in your participation. Then ask the same questions again. And if you know someone who is currently being invited into a guaranteed return with a name attached that makes it feel safe, send them this. That is the only version of clawback that works in advance.